Ladies and gentlemen, welcome back to the channel. We are at a very important level on the S&P 500, currently at $406.42 per share. We did clip that low at 405.75. Now, by the end of the day, if we do flush under 405, we're likely going straight to $400. And if you pull up the S&P on a daily candlestick chart, you are under all of these levels that I have marked. You are under the lowest level so far of 2022. So the situation now is worse than it has been throughout the whole entire year so far. And we're breaking record after record for downside moves, like in the month of April, dropping over 13% on the NASDAQ alone. Now, as you can see, if we do break under 400, we really have a gap to fill down here to about 385, 387. And that's going to be a very important level heading into the Fed. Now, the Fed is on Wednesday. So if we get the Fed that comes out, as the markets are falling through the floor, you could see a buy the dip kind of opportunity yet again in the broad markets like you've seen back here March 14th. Now, I want you guys to remember this. The lower we go into the Fed gives us a higher likelihood of actually seeing a rally after the Fed. If we rally the next 2 days, somehow we just miraculously, rally really hard the next 2 days, and then we get the Fed meeting, it's gonna be more, it's gonna be worse than not, right? The lower we go, the higher likelihood of seeing a bounce coming Wednesday and Thursday. The higher we go, higher likelihood that we do see a drop coming after the Fed. And the Fed is, like I said, on Wednesday at 2 p.m. You get the report that comes out. The Fed will outline what they expect to do. And then coming at 2:30, you get Fed Jerome Powell himself that comes out and says basically, hey, we're going to do this, this, and this. This is how we feel about the economy, so on and so forth. Now, I will tell you guys that you will hear this in financial media, that because the GDP report was really bad or certain economic factors are not looking so good, that the Fed might actually slow down. I am not in that camp. I think the Fed at this point, regardless of what the economy does, has to raise rates a certain extent very, very shortly. Like if the economy starts to signal that it is slowing down in a very dramatic way, the Fed will likely have to get even more aggressive raising rates. And I think that's what the markets are going to be paying attention to after a 1.4% drop in GDP in the first quarter. Second quarter, we could be into a recession. That's only 3 months away. The markets want to see, does the Fed go less? Are they kind of concerned about the economy and they're going to try to cater to the economy now? Or are they going to raise rates and pretty much solidify that recession next quarter or later on throughout 2022. So I think that is going to be very, very important to keep in mind. And you might be asking yourself, well, if the economy is slowing down, why would the Fed go more aggressive? Well, it comes down to the simple fact of when economies slow down, when our economy slows down, we go into a recession, the Fed always cuts rates to accommodate the economy. Now, we have never went into a technical recession when rates were at 0.25% or 1%. It's usually in between 3, but really, 5 to 6, 7, 8% is where the rates are when the recession comes, and then the Fed will reduce interest rates dramatically, sometimes down to 0, to accommodate the economy. If the rates are at 0.25%, there's nothing the Fed can do. So in a weird way, this could be a new dilemma that starts to happen, and this could prevent that soft landing that the markets want. The worse the economy gets, potentially the faster the Fed will have to raise rates. That's my personal opinion. I could be wrong, and keep in mind, this is not financial advice. I don't know Fed Jerome Powell. He's not my family member. I can't ask him, and I cannot relay to you guys like I know exactly what is going to happen after the Fed. But I do know the markets are about to move big one way or the other after the Fed. We're either going to see a major rally, and this is based off of where we currently sit in the markets. You're either going to see a rally, in my opinion, back up to 425 to 440 on the S&P, or you're going to fall down to potentially 380 on the S&P. And that's the most important thing to know. I don't know which way it'll go, but I do know that the markets will move big in a very dramatic way after the Fed. Now, as far as AMC stock, we are seeing some very interesting things that are happening today. We are down about 3.73%. All things considered, what is happening today, it's not a huge bad day. We are under $15 per share. We are currently at $14.73 per share. We will see if we get a rally into the end of the day, but it kind of looks like we're going to get a sell-off into the close of the day today. But nonetheless, either way it goes, there's some really interesting things happening with the option activity. So you're looking at 4 orders totaling $537.23 thousand, positive order value of 87%. So an 87% positive order value. With a lot of these June 17th, you could see $15, $20 strikes coming through. And even right here, a May 13th $15 call that is coming through. All of these positions for about 50,000 a piece. So there is some people that are betting on AMC here in the short term, and you are seeing that reflected in the option activity. It does not always mean it's going to materialize into an actual rally, but it can be a good glimpse into potentially what could happen next. So I think that looks very, very bullish for the day. The short interest currently being reflected at 18.76%. Current shares that are sold short of 96.71 million. Cost borrow max of 4.33%. Utilization of 100% and days to cover sitting at 2.47. Now I will say you have certain stocks like Redbox that is, going crazy today. And I want to make this very clear that people flock to what is doing well. So you've seen a lot of people lately flood into Redbox. And I mean, if you're watching this video and you have, congratulations, you probably hit a very nice trade. I wouldn't FOMO into it at this point, especially after 2 back-to-back 70 plus positive days. But these stocks come and go. So do the traders. So does the activity in these stocks. So what is ultimately going to happen is that AMC will get its time again, and you will see something equivalent of Redbox happening to AMC, but in my opinion, on a much larger scale. Now, circle this back to exactly what I've been saying in the last 6 months. Why do you think this is happening with Redbox right now? It's not because shorts are necessarily forced to get out of their positions just because the stock went from $1.61 to $10. That's not the case. They're being squeezed out because they don't have as much money to stay in their position. The liquidity has really dried up in a very substantial way. So that's key. Now, we did get some economic data as well that did come out today, and I know I'm kind of going back and forth, but there is a lot to talk about. We got the ISM. No, we didn't. We got, see, today. We did get manufacturing data, manufacturing PMI, and that came in worse than expected, but the cost of manufacturing actually did go down. So that is a key measure of inflation the Fed pays attention to. All in all, it was not good. So that is helping to fuel the market downtrend that we are seeing today. Now on Tuesday, you do get factory orders, durable goods, as well as the JOLTS job openings, and that's going to be very important. Expected to come in at about 11 million. Now, if there's less job openings, that could be seen as a good or potentially bad thing. It's what the Fed wants. They want the labor market to kind of come down and chill out just a little bit, right? Or at least remain stable, even if it is, incredibly high. But if the JOLTS job openings actually does come down in a major way, that could be a signal to the Fed, like I said, that maybe it's time to raise rates a little bit more aggressively, because if we head into a recession, there's literally nothing the Fed can do to help the economy at this current point. If the Fed only raised rates a 0.25%, another 0.25%, boom, we're sitting at 0.75 to 1%. Well, if the recession comes in the second quarter, you can't drop rates too much when rates are already very, very low at, say, 0.75%. So I hope you guys are picking up my drift there and exactly what I'm talking about, because this is going to be a key that I think the markets will start to pay attention to. Now, as well as that, on Wednesday, you do have ADP non-farm employment change. That will also be important, but the Fed is really going to dominate the headlines. That comes out, like I said, at 2 p.m. Here's the Fed interest rate decision. You do get the statement, and then you do get the press report right here, FOMC press conference, and you get analysts that ask questions, all of that good stuff, and that will move the markets in a very dramatic way. I'm telling you guys, it's either going to be very, very good or very, very bad. I really don't think there's any in between here when it comes down to Wednesday. You're going to get confirmation of potentially a market crash, or at least coming down in a substantial way, or you're going to see the markets rally again like they did the last Fed meeting. It's expected the Fed will raise rates 0.5%. Everyone's pretty much expecting that. Believe it or not, if the Fed only raises rates 0.25%, you might see a bullish reaction initially, but I would not, draw the line in the sand with that. Theoretically, if they only do 0.25%, it could be because, they're seeing the economy slowing down, and the markets might react favorably at first to that, but then the digestion period the next following days could actually be pretty bad. So I think the Fed is walking a tightrope here. They have to give us that 0.5%. If they do 0.25%, that could be seen as bad. At the same time, even 0.5% could be seen as bad, or it could just be, hey, the uncertainty's over, let's buy the dip again. We're certainly at a very attractive buy the dip moment here. Is currently on the SPY at 406.40. Depending on where we go today, that's going to tell you a lot. Potentially what's going to happen heading into the Fed meeting. I will keep you guys updated on all of this information, so feel free to subscribe to the channel, hit the like button, all that good stuff. In the meantime, and it did not mean to do that, let's go ahead and pull up AMC. Let's go ahead and see what the max pain is, and then we will pull up the technicals, and the max pain is 1750 per share by the end of this week. So that would be a pretty decent move to the upside at this point. AMC is down about 4%, currently sitting at $14.68 per share. And the SPY is kind of hanging out right here. It's very ominous when the SPY does these things. It's been doing it all day, and then you've tended to hit lower lows after that. So be mindful of what happens with the SPY today. That will be very, very important. Now, AMC stock, we're sitting right under the 50-day moving average on the 1-minute candlestick chart. Obviously, we don't like to look at directly 1-minute candlestick charts, but you are seeing a lot of resistance at that level after it was a prior support level. So overall, showing a lot of bearish sentiment there. The MACD is bearish as well. It's been bearish for so long now, and it comes and goes. Like I said, the trading activity comes and goes. AMC will have a catalyst. It will have a reason for, the markets to push it up in a very dramatic way, and that's exactly what will happen. Overall, finding a lot of support, believe it or not, going back and forth around $15 per share. Like I said, we're under 15 right now, but we're not at $13 per share, right? The markets, the lowest point of 2022 before, today and over the past couple of days was back here when AMC was at $12.90 per share. So to put that in reference here, or perspective, if you look at the SPY, that was right here. The markets are now down here. AMC stock is still up here, whereas the low back then was down here at $12.90. So it is showing a lot more strength this time around. Nonetheless, the MACD very bearish, the RSI very bearish at 36.78 on the super overside sold to town, and really ready for a reversal in my personal opinion. That's why I'm saying here right now, if the markets continue to sell off into the Fed, you're more than likely not going to see a big bounce after the Fed. Obviously, I'm not a financial advisor. I don't know what the Fed is going to do, but that's kind of what I would expect. Now, the overall indexes, the NASDAQ is doing the best, only down 0.81%. Russell 2000 down 1.18%. S&P down 1.39%. And the Dow Jones down about 1.37 as well. We will finally hit a bottom when we do get a flush out in the markets, and when you do see a lot of those high-flying tech stocks like Apple, Amazon, Nvidia, Tesla, Google, all of these guys start to come down in a dramatic way. Maybe not as much as like your penny stocks, right? Maybe not as much as small caps or mid caps, but until they do come down in a substantial way. And there you have it. There is a new low on the S&P 500. So that is going to be all for this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns. If you guys are confused about anything that was said to you guys here in this video, we will be live 10 p.m. to 11 p.m. Eastern Standard Time, just like we always do tonight, and come join us on there. That'll be a lot of fun. There is definitely a lot to talk about, especially after a day like today, breaking under all of these key levels in the market. So thank you guys for watching. If you guys want to come trade with us live in real time, link down below in the pinned comment. Feel free to do that one. Support the channel, get access to all of my trades in real time, join a community of over 100 members active on a daily basis. So thank you guys again. You guys enjoy the rest of your day. Hopefully make some money out there. I will see you in the next one.